Why the ECB is likely to cut rates in June. Economic insights. The anxiety surrounding persistent inflation in the services sector that could compel the European Central Bank, ECB, to maintain higher interest rates for an extended period has nearly vanished, thanks to the ripple effects of Trump's tariff policies. François Villeroy de Galhau, a member of the ECB Governing Council, confidently states, "There won't be extra inflation. That is a strong guarantee, neither this year nor next year." This assurance comes as a relief to many, as the unpredictable nature of tariffs has created a complex economic landscape. Trump's increasingly protectionist trade stance has not only led to wild fluctuations in the stock market, but has also weakened the dollar while fortifying the euro. This shift, coupled with declining energy prices, also influenced by the tariff situation, is already exerting a disinflationary effect on the eurozone economy. As a result, fears of a second wave of inflation are fading. Villeroy de Galhau emphasizes, "Our objective with the ECB is around 2% inflation. We are almost there at 2.2% and should meet the objective. And that means something important. We still have a gradual margin for interest rate cuts." With the ECB poised to lower interest rates again in June, the focus has shifted to the incoming shock from tariffs. However, Villeroy de Galhau's sentiment of having room for a cut could quickly turn into a more urgent call to action if the repercussions of tariffs are more severe than anticipated, potentially pushing the already sluggish eurozone economy into a state of stagnation due to the impact on global trade. Just last week, the International Monetary Fund, IMF, revised its growth forecast for the eurozone down to 0.8% for this year, a drop from the previous estimate of 1%. The uncertainty stemming from Washington's protectionist policies, combined with a noticeable pause in investment, makes the future hard to predict, leaving many economists scratching their heads. An article in the Financial Times recently shed light on the looming consequences for the U.S. economy, revealing that container port operators and air freight managers are witnessing significant declines in goods transported from China. Logistics companies report a sharp drop in container bookings to the U.S. since the imposition of hefty 145% tariffs on Chinese imports. The Port of Los Angeles, a crucial entry point for goods from China, anticipates that scheduled arrivals in the week starting May 4th will be a staggering third lower than the same week last year. The potential impact on growth from tariffs and trade wars is just beginning to surface, and the economic landscape remains uncertain as we navigate these turbulent waters.